Okay, lecture number 3. This is VIX Financial Strategy, and we are going to be talking about call options. The very bare bones of what a call option is, how to trade it, and fully understanding the basics. What is a call? Call options are financial products that give the option buyer the right, but not the obligation, to buy a stock or bond. Now, these calls, when we're talking about stocks, represent 100 shares of something. So if I were to buy a call option on Apple, which we're going to use as our example in just a couple seconds, that gives me the right to own 100 shares. So call options, we are betting on price going upwards at a specific strike price. So remember, right to own 100 shares at a specific price at a specific time. So that's why we have expiration dates. Now, expiration dates range anywhere from a couple days for super liquid ETFs, like maybe SPY, but large cap tech stocks like Apple will be every week. So you can have expiration dates from very close, expiring next Friday, to the Friday after that, to up until 2 years from now. So those would be called leaps. Now, you're going to be paying a premium to trade this financial product. The premium will vary depending on what contract you buy, but we'll save that for another lecture. This is a very nice visual to understand a call option. Because we're betting on price going upwards, theoretically, a stock can go to infinity, so the profits are unlimited. The wonderful thing about call options is that you minimize your downside. So whatever money you purchase a call option for is the max amount of money that you're going to lose. Because of this, we can see that there's a lot of leverage with call options, but there's also a lot of risk and a lot of volatility. Now, in this visual, we see that there is a break-even point and there's a max loss point. As time goes on and price goes upwards, so does your contracts. Now, let's use Apple as a prime example of a call option that we could purchase. Let's say that Apple at $147 a share is a little bit cheap, and we think that price is going to go upwards by the end of the month, end of the year. So right now it is December 2nd, 2022. And we believe that price is going to exceed $155 a share by the end of the month. So let's just put a little visual. Let's put a line for where we think price is going to be above within that amount of time. So I'll put it right there. Now, I like to draw a little line for visuals on our expiration date. Our expiration date is going to be December 30th. So I'll put a line right there. Remember what I said about strike prices and expiration. So when I flip over to this option tab, we see that we have tons of different options to choose from. No pun intended. These options with the 0D on it just expired. Today's a Friday, all these options expired. Next week, the options expired December 9th. The week after that, December 16th, and so on. These ones are close to 2 years, so these would be the leaps that I was talking about. Now, these are all expiration dates. But within the expiration dates, you can click on a tab. We're going to click on the December 30th. That's our example and what we are betting on. Within this tab, we see that there's tons of different strike prices to choose from. Right now, I only have 10 on each side. I have 10 that are out of the money, and I also have 10 that are in the money. I will talk in another lecture about moneyness, the difference between in the money and out of the money. But for now, we're going to be focusing on out of the money. I can widen this a little bit more so I can see a lot more of these options to choose from. You can play with it right here as well, but basically we're going to limit ourselves to the first 5 on each side. Now, we believe price is going to exceed $155 a share. Now, if we were to buy it right at this moment, in the previous lecture, I talked about the bid and ask spread. If you haven't watched that video, make sure you watch it. But we see that between the bid and ask spread, that the midpoint is 1.74. Now, remember that call options for stocks represent 100 shares. So because we're using leverage, we're going to multiply this number by 100. Now, 1.74 is like $1.74. Multiply that by 100, you have $174. So whenever you see option prices, just move the decimals a couple points to the right. So $174 is what we're going to purchase this for. What does that look like visually? Now, this is our strike price, this horizontal line, and this is our expiration date, this vertical line. Let's draw another horizontal line for how much we purchased it. So because we bought it for $174 or $1.74, we're going to add $1.74 to our strike price. Now, our strike price was at 155. So 155 plus 1.74 is going to get us 156.74, roughly right there. Now we are pretty much done with our visual. Now, if price moves upwards in our direction by the expiration date, we will be correct about the move, and everything above this line is profit. But all of this will be profit as well as time goes on. Now, we're going to talk about theta burn, theta decay, all the reasons why your options will decay between that time, but this is a great visualizer of what could happen with the option price. Now, when you place a bet on a call option, you have to be right about a couple things. Let's look back to our slides. You got to be right about where the price is going, the strike price. You got to be right about when it is, so you'll be taking into account the expiration date. But you also have to take into account the premium. So we'll be looking at what price could do on the specific call option. This is a wonderful website to use. This is Options Profit Calculator. We typed in our symbol, Apple. The current price is 147.6. And when we look down, we see that this is our profit and loss. Now, the higher it moves up in the shorter amount of time, the more money you're gonna make. Well, you can be correct about the move, but if you're not correct about the time, you're still gonna lose money. So today's December 2nd, a Friday, and the market opens up December 5th. If price is at 149 by Monday, we have made 12% return on investment. Price is still at 149 within Tuesday, Thursday, Friday. We're sitting at break even. Let's move on to next week, next Monday. Now, this is 6 trading days from now. We are sitting at a loss. This is a good representation of time decay. But let's take a whole number. Let's say that price is right. We're looking at this 155 right here. If we were correct and Apple is trading at $155 a share in, let's say, 2 weeks, December 16th, we are going to be in the green by 86%. This is the power of leverage and call options. Our $174 contract now net profited us $151. Now, if the stock is still trading at 155 a couple days before expiration, we're going to be sitting at break even. And the day after that, we're going to be starting to move downwards into the red. What needs to happen for call contracts is that you need to exceed the strike price before the expiration to get into the money. But the beauty of call options is that you have exposure to high gains that expose you to pretty exceptional returns. All right, and in future videos, we're going to be talking about puts, which are basically the opposite of calls, how to use those, and how to bet on price going downwards. But you can also use puts to hedge your portfolio, hedge your positions, and future volatility. All right, now that will wrap up this brief lecture on calls, just the very fundamental basics. Stay tuned for the puts video. Thank you so much for watching. Stay tuned for the next lecture.